The year is 2024. The world watches as financial markets teeter on a precipice. Then, like a hammer blow, it hits. The Japanese stock market plunges. The Nikkei index experiences its single largest drop since 1987. The speed and ferocity of the crash shock even seasoned investors. From the trading floors of New York to the boardrooms of London, the question echoes, how far will this ripple effect reach? The answer, unfortunately, is far and wide. Japan's sudden downturn sends a shockwave through interconnected markets. European markets open sharply lower, mirroring the fear gripping Asia. Across the Atlantic, Wall Street braces for impact. Analysts scramble to assess the damage, to decipher the potential fallout. Will this be a repeat of 2008? Will it be worse? The seeds of this financial earthquake were sown long before this fateful day. Japan's economy has been grappling with sluggish growth and mounting debt for years. Despite repeated warnings, the government's response has been seen as too little, too late. The writing was on the wall, but few predicted the swiftness and severity of the impending crash. The morning of May 24th, 2024 dawned like any other in Tokyo. Traders took their positions on the floor of the stock exchange. The opening bell rang, signaling the start of another trading day. Within minutes, a wave of selling pressure hit the market. The Nikkei index began to slide, turning into a full-fledged freefall. News outlets scrambled to make sense of the unfolding chaos. Panic spread like wildfire, fueled by social media and amplified by 24/7 news coverage. The economy. The shock waves from the Japanese stock market crash reverberated across the globe. European markets plunged in sympathy with their Asian counterparts. The FTSE 100 in London, the DAX in Frankfurt, the CAC 40 in Paris, all major indices were painted red. Investors adopted a sell first, ask questions later mentality. Across the Atlantic, all eyes were on Wall Street. Analysts and economists offered grim predictions, fueling the atmosphere of anxiety. As the sun rose over Manhattan, the opening bell of the New York Stock Exchange rang out. The Dow Jones Industrial Average immediately plunged, mirroring the carnage in Asia and Europe. The S&P 500 followed suit, each ticked downward, a hammer blow to investor confidence. Blue-chip stocks plummeted alongside smaller companies. Tech giants saw their valuations shaved as the sell-off became indiscriminate. The mood on Wall Street was eerily subdued. The air was thick with uncertainty, a palpable sense that the worst might be yet to come. The year 2008 is etched in the collective memory of America. The collapse of Lehman Brothers and the ensuing credit crunch are wounds that have yet to fully heal. Now, with the Japanese market in freefall, the question is, are we on the precipice of another 2008? The similarities are undeniable, but there are also key differences. Central banks have learned valuable lessons and are better equipped to respond with swift and decisive action. This is a new crisis with its own unique set of challenges and potential consequences. As the markets reel from the Japanese stock market crash, experts and analysts around the world are scrambling to make sense of the situation. This is not just a Japanese problem, warns Dr. Emily Carter. The interconnectedness of the global economy means that a shock of this magnitude will inevitably have ripple effects. Mark Williams echoes these concerns, warning of the potential for a global contagion. Even those who urge calm acknowledge the gravity of the situation. Uncertainty reigns as experts warn of potential fallout from the Japanese crash. As fear and uncertainty grip the markets, investors are seeking refuge in traditional safe haven assets. Gold has seen its price surge as investors flock to its perceived safety. U.S. Treasury bonds are also benefiting from the flight to safety. The yield on the benchmark 10-year Treasury note has fallen sharply. The Swiss franc has appreciated sharply against its major counterparts. The question now is whether these traditional safe havens will be enough to weather the to retrace its steps. The Japanese stock market crash has reignited the debate about Bitcoin's true nature. Is it a genuine safe haven asset, or is it merely a speculative bubble? The evidence is inconclusive, fueling both sides of the argument. Bitcoin's history is short and tumultuous, making it difficult to draw definitive conclusions. Proponents of the decoupling theory point to specific instances where Bitcoin's price has moved independently of traditional assets. Skeptics argue that Bitcoin's price is driven primarily by speculation, and that its perceived safe haven status is more psychological than fundamental. Within the vast and volatile ocean of the cryptocurrency market, the Japanese stock market crash has triggered a flurry of activity. Institutional investors are closely monitoring the situation. Some whales have reportedly increased their Bitcoin positions, betting on its long-term potential. Retail investors are responding with a mixture of fear and excitement. Some are buying the dip, hoping to ride the wave of volatility. Others are selling their holdings, fearing further losses as the global economic outlook darkens. Section 4. The Future of Finance. A Fork in the Road. The Japanese stock market crash, a stark reminder of the fragility of the global financial system, has brought the debate about the future of finance into sharp focus. Bitcoin and other cryptocurrencies, once relegated to the fringes of the financial world, are now being seriously considered as potential alternatives to the status quo. The current crisis has exposed the vulnerabilities of the traditional financial system, its reliance on centralized institutions, its susceptibility to manipulation, its lack of transparency. Bitcoin, with its decentralized nature, its immutability, and its potential to empower individuals, offers a compelling alternative. However, the road to widespread cryptocurrency adoption is fraught with challenges. Volatility, regulation, security, and scalability are all hurdles that must be overcome. The technology is still in its infancy, and its long-term implications are not yet fully understood. The coming years will be crucial in determining the future of finance. Will the Japanese stock market crash be remembered as the catalyst that propelled Bitcoin and other cryptocurrencies into the mainstream? Or will it serve as a cautionary tale, highlighting the risks associated with these nascent technologies? The answer, like the future itself, remains unwritten. The Japanese stock market crash of 2024 has cast a long shadow over the global financial landscape, shaking the confidence of investors and policymakers alike. It serves as a stark reminder of the interconnectedness of our world, where a tremor in one market can send shockwaves across the globe, affecting economies far and wide. As we navigate the road ahead, the fog of uncertainty hangs heavy, obscuring our vision of what the future holds, making it difficult to predict the next turn. The path forward is fraught with challenges. each step requiring careful consideration and strategic planning. Inflation continues to erode purchasing power. Central banks grapple with the delicate balance between controlling inflation and stimulating growth, and geopolitical tensions add another layer of complexity to the equation, making the situation even more precarious. The decisions made by policymakers and investors in the coming weeks and months will have far-reaching consequences, shaping the economic landscape for years to come, potentially altering the course of global markets. Will the global economy prove resilient, bouncing back from this latest shock and resuming its growth trajectory, or will it falter under the weight of these new challenges? Or are we on the cusp of a prolonged period of stagnation, marked by low growth, high inflation, and persistent uncertainty, which could redefine economic norms? The possibility of a full-blown global recession, while not the base case scenario, cannot be entirely ruled out, given the current volatile environment. In these uncertain times, one thing is clear: knowledge is power. Staying informed is not just an option but a necessity. Staying informed about global economic developments, understanding the risks and opportunities they present, and making sound financial decisions are more critical than ever. This knowledge can be the key to navigating through these turbulent times. The Japanese stock market crash could be a harbinger of broader economic vulnerabilities. Japan, a bellwether for developed economies, faces a shrinking population, deflation, and government debt. These challenges are emerging in other developed economies too. Aging populations and rising healthcare costs strain these economies. Japan's experience should be a wake-up call to address structural imbalances. The global economy, already strained by a pandemic and geopolitical tensions, can't afford another crisis. If Japan's issues spill over, it could trigger a global recession. A coordinated global effort is needed to address these challenges. The future of the global economy depends on decisive and collective action. Promise or fall short.